Hi, this is Brian Resney, President of Resney Wealth Management, bringing you another update about the economy and the markets. The Fed came out yesterday with their minutes and kind of a summary recap, and as expected, and as I've told you quite a bit, the U.S. is in store for really a slow growth economy, not only the rest of this year, but certainly 2011 and probably 3 to 5 years in my estimation. It's going to take time to work our way out of this hole, and if you are primarily invested in larger cap U.S. equities, whether that's through a mutual fund or individual stocks, unfortunately, I believe that was yesterday's winner. So if you are overloaded in U.S. equities, I think that is a recipe for mediocre results going forward for some time. It's going to take time to bring in the debt load. Obviously, we are looking at higher taxes next year, which I do want to touch on. I think we have a better than 50% chance now that the Bush tax cuts will actually will stay in force, at least for some people, for at least 1 to 2 years. That's kind of my prediction, and I wouldn't be shocked if we hear something in the upcoming 30 to 60 days. If that happens, we could have a further extension of this rally. I also believe, based upon the FOMC meeting that came out, the notes yesterday, that the Fed is probably going to do some more quantitative easing, QE2 as we call it, which could possibly push the market up even more. Our short-term indicators hit a buy signal. We did add back to some risk equities based upon our allocations per client and per risk. So as an active money manager, and not a so-called advisor, our job not only is to reduce risk or control risk within a client's portfolio, but also add a little bit of risk when it's appropriate. I talked about that well over 2 weeks ago. Hopefully you've taken some of my advice. Now our indicators could change obviously at any time, and we are seeing quite a bit of volatility out there. That's why if you are a conservative investor, you need to be conservative, but that doesn't mean you have to run away from all risk assets, and maybe it means you need a smaller percentage. It was interesting. I had a conversation 2 days ago with a gentleman at our Boca Raton office. And it was interesting to note when I was talking to this individual, his big concern was he was with a big brokerage house. He had a multi-million-dollar portfolio. They were giving him a proposal to put them in their money management program. They act not only as a broker, but also as an advisor or hire sub-advisors to basically help manage their clients' money. He asked me what did I think about the proposal. So I took a look at the proposal, and I said I have a few problems with the proposal. I said, number one, their fees start at 3% and tear down to about 1.5%. And on your size portfolio, you're going to pay better than 2% a year. I said that's almost 50% higher, or double, what a normal fee-only registered investment advisor would charge. That's number one. I said number two is I'm looking at the investment lineup that you have in your portfolio, and they're all mutual funds that are sponsored by this particular large brokerage firm. By the way, most of the brokerage houses all do the same kind of business. What that meant is, to this person, it meant that they had in his portfolio, or would put in his portfolio, sponsored mutual funds that this firm has a selling agreement to sell. They probably get extra commission, sales incentives, and marketing in order to send dollars to these particular mutual fund companies. Also, these mutual funds that were in his portfolio, most of them were mediocre at best. There's a few that are okay. One of the particular funds that I actually do like is the PIMCO Total Return Fund, which is basically a bond fund. The problem that I told this individual is PIMCO actually has 5 or 6 different variations of that exact same fund. Unfortunately, the fund that they are showing him is actually the more expensive share class on an annual expense ratio. It's actually better than 1% per year annual internal cost. I said they have a similar fund that actually runs less than 60 basis points. So what that means is, again, it's about half the internal cost. You need to not only look at what this advisor is charging you, or so-called advisor, but you need to look at the investment products they are putting in their portfolio. So what I explained to this person, even though this particular fund, this PIMCO fund, has maybe 5 different funds in the exact same fund category as this fund they're showing him, there are funds that are actually cheaper in that same category that have a cheaper annual expense ratio. Folks, you need to understand that expenses do have an impact on your portfolio. If you're working with one of the large brokerage houses, often they are going to put inside of your portfolio investment products that they have a selling agreement to sell that may be of a higher internal expense ratio than a fee-only registered investment advisor can get for you. So again, take a look at your portfolio, and just because you're working with a large firm doesn't mean that you're getting the best or the most quality or at the most reasonable, realistic cost for you, the investor. That does have an impact. The other problem that I said with this person is you have a portfolio that's going to be a set it and forget it portfolio. Based upon their model, they're going to rebalance that portfolio once or twice a year. There's not going to be risk management in that portfolio. What that means is you're now in your 80s, and they're going to put you in equity exposure, and they're going to keep you there up and down and up and down. That's the buy and hold syndrome that I talk about often on my radio show. Risk management, folks, is the most important part about money management. I'm going to watch as we go through the rest of this week. Our indicators, our long-term indicators, are starting to show an increased uptrend. I want to see what's going to happen today. We may actually add a little bit more equity-based investments to our portfolio. As I talked over 2 weeks ago, we continue to like the emerging markets, which we added to. We also added to some more short-term bonds, some of the prefers that we have within our portfolio for income purposes. So we are very cognizant on not only risk management, but also providing income opportunities within our client portfolios. Folks, you have to make sure that your portfolio is being managed actively, that you don't have a buy and hold mentality, because unfortunately I believe that's going to be a recipe for mediocre returns over the next decade. This is Brian Resney with Resney Wealth Management. If you'd like to talk to us, if you've had enough of hold on, things will come back, you'd like to talk to an independent, fee-only registered investment advisor who has your best interests at heart, call our office. We'd love to give you a complimentary consultation, either at our Boca Raton office, Coral Gables office, Fort Myers, or Naperville, Illinois. We do manage larger portfolios of $500,000 on higher. If you'd like to sit down with us and talk about your investment and retirement needs, call us. We would love to help you. Have yourself a very profitable week.